again.
That's it.
So what we did so far, we looked at financial institutions, their functions, financial intermediaries, their functions, why they're important to us, to the economy. We looked at what makes them so special. Why is it that the banks in particular are so heavily regulated? And based on their functions, we know that the crux of the matter is that they take our money, all right? And we need to make sure that our monies are protected. Not only that, they play a critical role in our economy. Yeah? What are some of the other things that financial institutions do? Remember?
Yes, functions. They have many functions. Like
What are some?
intergenerational wealth transfer.
Intergenerational wealth transfer, wonderful. Janelle? Huh? They give loans, But what else? They provide us a means of doing what? Investment in securities. When you invest in securities, it's called asset transformation. It's one of the key functions. So you put money in the bank with loans, that's a transformation of an asset. You have money, you purchase a security, all right? So this asset transformation and a number of other functions. But we also know that part of the reason that they need to be regulated is that they face a lot of risk, all right? And we would have looked at, we would have talked about it briefly. So today we're going to be talking about the risks that financial institutions face, all right? I'm not going to go into them in detail because we're going to take each risk and we are going to talk about how it arises, what are the ways that financial institutions, how they mitigate the risk, how they're able to identify the risk, and what it is they do to make sure that they, if not eliminate that risk, they reduce it as much as possible. So we're going to focus in on that, on each of them later in the semester. Today, though, once we identify what those risks are, we're going to talk about technology and operational risk. Now, in the book, you'd find that, or in the course outline, I think technology risk falls a little lower down. But I like to do it first because it is the risk that kind of covers everything in an organization. All right? Remember we mentioned enterprise risk management early on. An organization faces risk in just about everything. The operational and technology risk kind of covers a good bit of that, of the other type of risk that's not related to the financial side. Okay? So our objectives for today, we should be able to critically discuss the various risks faced by financial institutions. When we say critically discuss, we mean you're not just identifying them, you're not just defining them. How they arise, what are some of the ways to mitigate them? Are they related in any way? Okay? Have a basic understanding of the different types of risk. So interest rate risk, market risk, credit risk, off-balance sheet risk, foreign currency risk or foreign exchange risk, country or sovereign risk, technology risk, operational risk, liquidity risk, and insolvency risk. Right? So we are going to have a look at, learn what they are, and then we go into them in more detail, right? So we know that companies are there to make a profit, all right? We also know that when we invest money, we want a profit from what we get, from what we invest. And so risk reduces your profits because it increases your cost, all right? And so risk tends to be quite debilitating for some companies if they're not able to address it. So we're going to look at that. In terms of like the quantitative assessment that they mentioned here, these slides are from the book. That will be done later on, okay? So what is risk? Risk is a chance that the outcome you're expecting is not the outcome you get, all right? And that sounds simple, it's very simple, and so that tells you that there are risks in just about everything, all right? There are three main types of risks that we look at, not types of risk, but functional categories, all right? So you have the risk that can be removed, avoided, totally eliminated. There's some risk that you can transfer to somebody else to take it away from you. Karen, you good?
Yeah.
You look like you had a rough day so far. Anyways, you'll be good by the end of this class. You need glasses, Kiran?
No.
Sure?
Yes.
Kiran, they're squinting at me. All right. Risk that must be actively managed at the firm level. And the risk that must be actively managed are what we're going to focus more heavily on those. Because some you can just eliminate them. You can avoid them. You can move some of that risk over to somebody else. All right? So let's look at the different types. So the first one, interest rate risk. Just about all financial institutions face this risk because they are all involved in some way, shape, or form with interest rates. All right? So interest rate risk arises within financial institutions because the maturity of their assets and liabilities don't match. Right? So you have an asset maturing tomorrow, liability maturing a month down the line. They both have interests. They both attract or pay interest. Those amounts, the maturities don't match, and so you have to find a way to reduce the exposure to that risk. All right? Then there's market risk, and basically market risk comes from the other risk in the market. Okay, so you invest in securities, you trade currencies, so you hold in currencies, all right? You trade in bonds, so there's price, interest rate, this is gonna affect the price of bonds. Market risk arises from those other risks that are faced by when you're trading, all right? So whether it be stocks, bonds, foreign currency. And so that's the risk from the market. That the risk that they face, there are risks, other risks that they face, and together they affect the pricing of securities in the market. All right? Then there's credit risk. And credit risk is the risk that you are not going to get back. you're not going to get back the monies that you put out. All right? So put in a nice way, credit risk is a risk that promise cash flows from loans and securities that financial institutions have may not be paid in full. All right? So the bank gave a loan and the person they gave the loan to maybe lost their job, or they maybe decided, I have something else I would like to do with this money, and they do that something else, and they're not able to pay back the loan. Or people are just pure dishonest. Sometimes they can't help it, but some people just make a decision that this is an expense that I'm not going to honor. Off-balance sheet risk. It's not, off-balance sheet risk is not usually identified as a risk in general. But for banks in particular, they incur off-balance sheet risk, all right, because they engage in activities that are not part of their principal function. Okay? And so off-balance sheet risk is considered to be the risk that the financial institution is exposed to as a result of activities related to what they call contingent assets and liabilities held off the balance sheet. What is that? We know that banks have their assets, so what? A bank's assets include what? Loans, okay? Securities, right. Their liabilities include what? Deposits. And so we know that banks are in the business of taking deposits and giving loans, right? But banks also invest in securities. Banks also trade foreign currencies. Banks also trade in futures and options. And so those contingents, not directly on the balance sheet, but those other investments they make, all right, in certain assets and liabilities that they incur, create risk for them. That's called off-balance sheet. So when we look at off-balance sheet transactions, we will see where that arises from. Any questions? All right. So there's foreign exchange risk. We would have looked at these. You would have seen some of these risks in some way, shape, or form before. All right? Because you would have done some course along the way that exposed you to the risk. So foreign exchange risk. That's the risk that changes in the exchange rate will affect the value of your assets and your liabilities. All right, that are not in your domestic currency. You may also learn it another way. Foreign exchange risk is a risk that arises from the appreciation and depreciation in currencies, but you have to have an asset in another currency to be exposed to that risk. Okay? Country or sovereign risk. Country risk comes from when in relation to financial institutions, if there is a problem in one country and you have investments in that country, then you have a problem that arises due to a government regulation or an action by a government that affects the value of your asset, that is considered country risk. So, and then we don't have it here, but political risk is also related to country risk, because in political risk, Governments make laws, they change regulations, they have certain requirements, and because of that, the value of your assets may change, or investors may decide not to hold your asset anymore, so they sell it off, and so that poses a risk. So country or sovereign risk, the risk that the repayments by foreign lenders or investors may be interrupted because of restrictions, interventions, or interference by foreign governments. Sometimes a foreign government, let's say a dictator takes power in a foreign government, that dictator can decide that its citizens should not invest in securities from the United States. All right? Trump has signed lots of executive orders. He could sign one that says Americans should not invest in Chinese securities. He may say that, you know. So that would affect that's country risk. Technology risk, that has to do with technology failing, all right? The way it is put here, the risk incurred by a financial institution when its technological investments do not produce anticipated cost savings. But you could also have technology failing that leads to operational risk. But the technology risk is defined as that risk that arises because the investments in technology do not produce the anticipated savings in costs. Sometimes technology risk is blurred with operational risk. They sort of go together, all right? But they're different. Now, operational risk, the risk that existing technology, auditing, monitoring, and other support systems may malfunction or break down. Operational risk also arises from actions by employees. Employees not following the rules, employees not following procedures, employees not using the technology properly. All right, so that's operational risk. Then of course there's liquidity risk. Liquidity risk arises when you have withdrawals from a financial institution, a sudden sell-off in assets, all right? The risk that a sudden surge in liability withdrawals may require a financial institution to liquidate or sell off the assets in a short period of time. And when you have to sell it off quickly, you may not get the price that you're looking for it. Okay, so the price is less than fair market prices. Insolvency risk, that's the risk that a financial institution does not have enough capital to offset the reduction in the value of its assets. So, bank issues loans, all right? Persons are defaulting on their loans. If the bank doesn't have enough capital to make up for that, then the bank can go insolvent. And we'll see a little bit of, we'll see that later on how the bank goes insolvent. Because when you don't pay off a loan, then it hits your equity, all right? Underwriting risk, the risk to a financial institution from assessing the creditworthiness of a potential customer, all right? And in assessing the creditworthiness of the customer, you make errors. So that's a risk of underwriting. So, pure book definition, the risk to a financial institution arising from assessing the creditworthiness of a potential customer, whether through the sale of securities or issue of various types of credit guarantees on or off the balance sheet. You'll notice that these definitions are very wordy. And if you pay attention to the words, you may get lost in them. So it's important that you understand what it means. All right? So on the writing, you're looking at, on the writing also has to do with the credit worthiness, but you're making that assessment up front. All right? You're looking at a potential customer, like an insurance company, will incur underwriting risk if they assess a customer and don't assess that customer accurately. So the risk that that customer is not going to pay their premiums, that's one, that's an underwriting risk. The risk that you sell a customer car insurance and that customer either doesn't pay the premium or that customer is doing things that puts that vehicle that you're insuring, that the insurance company is insuring, at risk. So driving dangerously. All right? So that's underwriting risk. We spoke about interest rate risk, and interest rate risk is broken down into two elements. All right? So you have interest rate risk comes from the risk of refinancing and reinvestment. So what does that mean? Let's start with reinvestment risk. Okay? And reinvestment risk generally comes from purchase of bonds. Bonds have coupons, right? And the prevailing interest rate when you purchase the bond was, I don't know, 5, 10, 5, 6%, right? And so the interest on your coupon or the interest on your deposit, your fixed deposit, for example, when you make the investment is, let's say, 7%. All right? When that investment matures, you tend to not pull the money out, but you tend to reinvest it. When you get that interest, you tend to reinvest your principal, but you also reinvest the interest on a low when you do a fixed deposit. That interest that you had, which was 7% of your principal, if interest rates go down, you're reinvesting it at, let's say, 5%. It's a low rate, so that's reinvestment risk. When it comes from a bond, if you have a 10% coupon and interest rates fall 2 percentage points to 8%, when you get that coupon payment and you reinvest it, you're not getting the 10%, you're getting 8%. So you lose money. So that's reinvestment risk. Okay? Refinancing risk, okay? The risk that the cost of rolling over or reborrowing funds will rise above the return being earned on asset investments. Refinancing, the risk that the cost of rolling over or reborrowing funds will rise above the returns being earned by the asset investment. So that's where the risk, the interest rate risk comes from. It's a mismatching assets and liabilities maturity, and at the time of maturity, the interest rate is different. So you have a refinancing risk if you are issuing funds, and a reinvestment risk if you are investing funds. All right? So when the financial institution or the refinancing risk comes about, if you have your assets have maturities longer than your liabilities, then you end up with refinancing risk. Okay? I'm skipping through the examples. Just for you to read. By the way, FINA 2005, you have different slides to this, but the information is the same. All right? You don't need to go as in-depth as 3076, so your slides will be different. I'm teaching from the 3076 slides because they're in-depth and I give more explanation, but the 2005 slides are a little bit more basic. All right? And you're responsible for that. Not for these, because these are not what I'm giving you. However, I don't know if you recognize it, it's the same book, but how I set your exam, then midterm will be different. Okay. All right. And I explained the investment risk already, and I'm going to skip over these slides. We'll do those we'll look a little more closely at that in tutorials. Right? So credit risk comes because people don't pay what they're supposed to pay. That's the long and short of it. And so to be able to avoid credit risk, financial institutions, you have to screen your customers, your loan applicants, but you don't just screen them, you have to monitor how they pay their loans. And in screening them, you're going to check with other financial institutions. Now we have a credit bureau, and so the credit bureau will collect the information from the financial institutions, and so each person will have a credit profile. All right? I'm not sure if they're doing credit scores yet, but they'll have a credit profile. I think yes, I think they're doing credit scores. I haven't done enough research on that yet. So we really spoke to credit risk already, so I'm not going to spend too much time here. Now, there are two types of credit risk that we look at, all right? And so you have firm-specific credit risk. So when a bank is lending to a company, all right, you get a risk arise from that because the type of company you have, all right, because of the business they're in, they present a particular type of risk. So hotels, right? Because of the business of hotels, their risk to the institution really comes from if we have a disaster, if we have a hurricane, the hotel is not able to attract, people are not going to come to the hotel may get damaged, and so people can't come in and they still have to now fix the hotel, and so they run into a problem. All right? A telecommunications company has a different kind of risk. So you have firm-specific risk, right? And you have what we call systematic credit risk. The systematic credit risk and systematic risk in general, if we're even talking about securities, financial assets, that comes from the risk of default that's related to what's happening in the economy. So if the economy is doing poorly, the risk of default is going to increase. So that's called systematic credit risk. So you have firm-specific, which has to do with the business that the firm is in, and then you have the systematic credit risk, which has to do with what's going on in the general economy. So whatever affects everybody, the risk, whatever affects everybody that causes them to not be able to pay, that is called systematic credit risk. Now, liquidity risk, I know we're going a little quickly, but we're gonna dissect each one a little more. All right? Liquidity risk. So for a bank, you know, banks take deposits, right? The monies they get from the deposits, they use those monies to give loans. Those are the same monies they use to cash your checks, all right? So they need to have a certain amount of liquidity on hand. Now, if there is an excessive amount of withdrawals, so if a bank is accustomed to have an average of, I don't know, $20,000 a day withdrawn, and suddenly $20,000 a day is not realistic, but so let's use 100,000. Their withdrawals are normally 100,000 a day, and all of a sudden, on a Thursday as opposed to a Friday, they have withdrawals of $1 million. That could pose a liquidity risk for the bank, because the bank may not have $1 million on that Thursday, because normally their withdrawals for a Thursday is 100,000. So they don't keep that cash on hand, right? So you have liquidity risk. That presents a liquidity risk for you when there are sudden changes in withdrawals. All right? So if you have so for example, whenever we hear there's a hurricane coming, what's the first thing people do? They go to the bank because they're going shopping. So they go to the bank, they go to the supermarket, they go to the gas station. And so you always end up with, you could have a liquidity crisis if banks don't have enough cash on hand. All right? Now, banks, they have, so like for Antigua, for example, they have cash in their vaults, right? Each teller has a certain amount of cash in the till, they have an in-house vault, they have cash in the vault. They can also access liquidity from other banks. So they can access cash from other banks, they do like overnight loan, right? They can access cash from the central bank in our case, and in every case, you can access cash from the central bank. So the central bank is located in St. Kitts, but the central bank also keeps some cash on hand here in Antigua, all right? And so they maintain that vault in one of the financial institutions. And so what you find, different banks will collect additional cash on different days, all right? So you go downtown and the armored truck in the middle of the road with the guys with the big guns, and you can't move, you can't go nowhere. If you're on foot, you can move, but you know, you're afraid to get in the crossfire, so you don't walk on the other side. You're not going to walk on the other side, you take another street. Right?
Big gun there.
That's when they're moving money, they're moving cash. All right? A lot of times they're moving just coins. Okay? The armored truck's not so bad. To me, the bad ones are when the police just go crazy and fly down the road and no regard for anything, because they're taking money to the bank. Sometimes I should have said, but they disrupt everything to get to the bank. But the movement of cash, where banks are trying to maintain that liquidity, all right? So liquidity risk arises from that sudden surge in demand for cash. All right? Now, financial institutions are only going to keep as much cash as they normally need to. So that they're going to look at the trend So on different days, you need different amounts. At different times of the year, you have an increase in cash. So what times of the year you think banks need to have more cash on Christmas, Carnival and Christmas, right? And yes, and when there's hurricane about, right? Because and you do need to have cash on hand, because if things really get bad, if things get bad, you can't use a debit card. All right, you can't go to the bank, and you need stuff. You need emergency items, so that's why medical benefits will tell you, try to ensure you have a certain amount of medication, and so on and so forth. All right. Now, foreign exchange risk, all right? The risk that exchange rates will change and it affects the value of your assets, all right? And the liabilities that is denominated in foreign currency. So, when we talk about foreign currency, you say, if you're net long, it means that you have a lot of foreign currency. You have excess of foreign currency. So if you are net long, you are afraid that there's a depreciation in the currency because you're going to use more money, right? If you're net short, which means you have less foreign currency, all right? And net here, we're talking about assets and liabilities. So when we say net long, you have more foreign currency assets than liabilities, all right? So you don't want the currency to depreciate, because the value of your assets is going to decline. And when the value of your assets are going to decline and your liability increase, then you have a problem. Net short means that you have less foreign currency assets than foreign currency liabilities, right? And so you fear appreciation because the value of your liabilities will increase, right? When you have assets in different currencies, it doesn't mean that the returns on what you have in domestically is going to be the same as the returns you have outside. So, for example, a company may invest in U.S. securities, but may also invest in euro-denominated securities. And the return on the investment is different. And the return on the investment is different based on interest rates, what the interest rate is in each country. All right? So interest rates in the US may be 5%, the interest rates in Europe is 3%. What tends to happen is that if the interest rate in the US is higher, people are going to want to go to the US to invest in the US because the rate is higher. However, depending on the value of the currency, all right, you could end up losing money. We talk about interest rate parity. I don't know if you've ever heard of that. Interest rate parity. I think we talk about it later down here, and we also talk about it to those of you in 3053. All right? So the returns on investments in different countries are different because of the interest rates. All right? And then you have as interest rates change, the demand for the currency changes, and so you have that risk, because if the demand increases, then currency appreciates, and if you have more liabilities, then you're going to run into a problem. So that's an important distinction to make. So an example, this is a good example. So a U.S. financial institution loans a British company money in sterling, all right? If the pound sterling depreciates in value relative to the US dollar, when the British company pays the interest and the principal, the money they get would be of less value, because they are paying in sterling, the sterling depreciates, and so the value of the payments they get would be less relative to the dollar. All right? And so if the pound sterling continues to depreciate, when you convert that money back into dollars, you're going to get less dollars. So that's where the foreign currency risk comes from. All right? And we will go more in depth in that later on. And we spoke about country or sovereign risk. And so if governments impose restrictions, all right, so the US company lends sterling, all right, what could be the interference? The country, let's say the Bank of England, because it has a change in the political environment, Bank of England may say, you need to pay a tax on monies going out of England, right? If you have to pay a tax on monies going out of England, the person has to find more money to pay its bill, to pay the loan. If you have to find more money to pay the loan, it means you have less money to pay. You have less money available to you to pay. So you may default, or you may pay less than you are supposed to pay. All right? Also, you may have a situation where a country's currency is devalued to the point where you end up with a foreign currency shortage. Right? So that poses a risk. And then the political activities also pose a risk for currency. Then market risk that comes from active trading, the different types of risk creates that market risk. So you have changes in interest rates, you have changes in exchange rates, and you have just the movement, changes in prices that creates market risk. All right? Now, the market risk results in the change of the value of your assets. You can protect yourself from that by what you refer to as hedging. Okay? This is one of the risks that you can cover some of it, but you won't get rid of all of it. And so you can hedge to get rid of, to remove some of it. All right? This is also called, the risk that can be hedged but cannot be diversified completely away is called undiversified risk as well. Okay, so systematic risk or undiversified, the risk you may hear that those of you who do who will get to portfolio management, right? Or financial institutions and markets.
This, I still have a problem with that. The problem is like, if you want to invest in something, it's like you have a belief that you get a return.
You think you'll get a return, but there's a risk that you won't get that return.
Okay.
So that's why you have to learn as much as you can about the area, and you also have to stay on top of what is happening in the market so that you can make a move if you think that the price of the security is going.
I guess
so you see the price of the security go down, right? And you have to make a judgment call as to if it's going to go down any further.
Right.
All right, based on what is happening and based on expectations.
I guess you're never 100% sure.
No, you will never be 100% sure.
That's what I want. Okay. Right.
Risk, once there's risk, if you're making more money, the risks are going to be higher.
Okay.
All right?
Okay. Oh, it's unfortunate.
Okay, and the other one I want to look at, off-balance sheet risk. With financial institutions, in this case banks, all right, the activities that banks engage in that are unrelated to making deposits and giving, taking deposits and giving loans is called off-balance sheet activities, right? So these off-balance sheet activities, banks, that's another way for banks to make money. These off-balance sheet activities can pose risk, right? So letters of credit, that is where the bank writes a letter to say that this particular business is able to make its payments because we have some money put aside to cover that. Loan commitments is where the bank says to the trading, the person you're purchasing from, this person is good for it, but they're gonna charge that company that they are doing that on behalf of, right? So they make money from that. They make money from the letter of credit as well, because they charge you for the letter of credit. Then your derivative positions, that is when they're hedging. So they want to protect themselves against foreign currency risk. If they have investment securities, they want to protect themselves from price changes, and so they get into derivative trading where they may buy futures or they may buy options. Futures is where you go in the market and you make a purchase of what is foreign currency or otherwise at a pre-specified price for the exchange to happen in the future. So you're doing that today so that you're locking in the rates today, so that when you have to now exchange your asset in the future, you're exchanging it at that rate you lock in today and not the rates in the future. Right, so those are derivative positions. There was an underlying asset there. So with all of these, they pose risk to the financial institution, because with the letter of credit, yes, in most letters of credit, the bank asks the customer to put down a deposit, but the deposit may not be able to cover the full transaction. And so if the customer does not make the payment to the where they're buying from, then the bank has to make it because they made the commitment with that letter of credit. Similarly with a loan commitment, if the bank tells the supplier that this institution, this company is good for it, and that person defaults, doesn't pay for the goods they're importing, and the bank has to pay because they made the commitment, right? But the bank is only going to make a letter of commitment for customers that it has been monitoring, know that they have money in the account, know that they have good credit, right? And then derivative positions, because everything is based on an underlying asset, and there are changes in the market, anything can happen in the market, that's where most of the risk is. All right? So, off-balance sheet activity helps to mitigate risk, but it's not risk-free. All right? So, that is where that risk comes from. Any questions? All right. So, the different types of risk. Any questions on different types of risk? Everybody understands what they are? I can move on. All right, I'll move on shortly. Yes, so you wear flat shoes for comfort, but flat shoes cause another problem for me. My toes are cramping. They hurt because it's too flat. All right, so what did we say technology risk was again?
Risk.
Huh?
In terms of like let's say systems breakdowns or something.
System breakdown, you invested in this technology to make your business more efficient, but you didn't get that. All right, the equipment broke down, you have to spend money to fix it. You maybe lose some business because you don't have, the equipment is not there doing what it needs to do. All right? And so you make companies now especially are making more and more investments in technology. So the banks, for example, are making so much more investments in technology to try to speed up the service. However, we all know that in trying to speed up the service, they often have technological issues, because just this morning I saw a notice that ECAP drive-through ATM not working, right? And we all know that when it comes Thursday and Friday, after the first 10 people go to the ATM empty, or ATM breakdown, all right? Or you try to do an online transaction. That happened to me. That actually happened to me last month. Did my EFT, thought my EFT was done. 2 days later, when checked my bank account, but I did an EFT. I don't see it coming out of my bank account. Now that EFT is necessary because I had other transactions to do with other institutions, right? Now, had I incurred any charges because, let's say, a loan payment wasn't made on time because of that, well, I would tell the bank they owe me some money, right? And if multiple customers do this, then they have a problem. So we see that institutions are investing more and more in the technology, but something else affects that. So you invest in the technology, but you have frequent power outages, and although you may have a UPS surge protector, some of the equipment just cannot handle it, right? And so the equipment fails, because remember, most of the equipment have motherboards, so your air conditioning units, just about everything has some kind of computerized bits of equipment on it, and the fluctuations in electricity affects that, right? So although you may have some surge protection, you may have a backup generator, that dip, so sometimes the electricity doesn't just go off, it dips. The equipment is not able to respond quickly enough, and it affects. Something goes down, you may be sending transactions out, and those transactions, when it went down in that couple of seconds, some of those transactions you thought you sent didn't go. But you think you send them, and you don't realize they're not sent until you read the report later on in the evening. At the end of the day, you realize that these transactions didn't go out. Right? And so there's a risk from that. Institutions can lose money from that. All right? Now, operational risk goes a little deeper. The existing technology together with the support systems may encounter problems. So they may malfunction, they may break down completely, all right? But not all operational risk is due to technological issues. You have employee fraud, errors by employees, all right? You also have reputational risk because an employee did not do something. You have reputational risk because a customer lost money due to a cyber attack, all right? You have a reputation risk because you had a cyber attack, you know you had a cyber attack, but you did not deal with it quickly enough. And so you now have a reputational risk, which is considered operational, okay? Then you have what you call strategic risk, okay? So when companies merge, that merger could fail, and so there's a strategic risk. You have different types of risk throughout the organization, and most of those that cannot be identified as interest rate, liquidity, foreign currency fall under operational risk. All right? A lot of it, employee errors, employees not following procedures. Employees not following procedures could, you could end up with a reputational risk because of that. So your customer waiting time just gets longer and longer. That's a reputational risk. People are not interested. People don't want to stay in the organization for too long. You got to pay a bill, you want to pay the bill and be able to come out. Right? I remember First Caribbean many years ago, and even Royal Bank, they monitored, they could see how long you stayed in the line, right? And they tried to make your stay, they tried to cut your stay down to like, at one point it was like 20 minutes. We know that you can go in the bank and stay an hour and a half now, right? That doesn't seem to be an issue for them, but you get a bad reputation for it, all right? I remember working in government, and I don't know if they're still called that, but First Caribbean used to be called Last Caribbean. Anybody knows why? Everybody knows why First Caribbean is called Last Caribbean. But that was among government workers. Among government workers, they seem to pay last. All right? Like all the other banks would have paid, and because of their processes, they, you know,